Welcome everyone to UMC's 2021 first quarter earnings conference call. All lines have been placed on mute to prevent background noise. After the presentation, there will be a question and answer session. Please follow the instructions given at the time if you would like to ask the question. For your information, this conference call is now being broadcasted live over the internet. Webcast replay will be available within an hour after the conference is finished. Please visit our website, www.umc.com, under the Investor Relations, Investors, Events section. And now I would like to introduce Mr. Michael Lin, Head of Investor Relations at UMC. And Mr. Lin, please begin.
Thank you and welcome to the UMC's conference call for the first quarter of 2021. I'm joined by Mr. Jason Wang, the President of UMC, and Mr. Chi-Tung Liu, the CFO of UMC. In a moment, we will hear our CFO present the first quarter financial results, followed by our President's key message to address UMC's focus and the second quarter 2021 guidance. Once our President and the CFO complete their remarks, there will be a Q&A section. UMC's quarterly financial reports are available at our website, www.umc.com, under the Investors Financial section. During this conference, we may make forward-looking statements based on the management's current expectations and beliefs. These forward-looking statements are subject to a number of risks and uncertainties that could cause actual results to differ materially, including the risks that may be beyond the company's control. For these risks, please refer to UMC's filing with the SEC in the U.S. and the ROC security authorities. Now, I would like to introduce UMC's CFO, Mr. Chi-Tung Liu, to discuss UMC's first quarter 2021 financial results.
Thank you, Michael. I would like to go through the first quarter 2021 investor conference presentation material, which can be downloaded from our website. Starting on page 3, the first quarter of 2021, consolidated revenue was 47.1 billion NT, with gross margin at 26.5%. The net income attributable to the stockholder of the parent was 10.43 billion NT, and the earnings per ordinary shares were 85 cents NT dollar. In the first quarter, the capacity utilization rate was 100%, further improvement from 99% in the previous quarter. And please go to page 4. For sequential comparison, Q1 revenue 47.1 billion represent about 4% quarter-over-quarter growth, which contributed both from ASP increase of 3% plus, as well as wafer shipment, which is also 3% plus. And it was somewhat offset by the stronger NT dollars. Gross profit margin continued to grow to 26.5% or 12.5 billion NT. And operating income margin rate in first quarter was 16.2%, increased by 35.7% sequentially. So the net income as reported was around 0.85 NT per ADS is about 0.149 US dollars. So year-over-year comparison on page 5, revenue grew by 11.4% despite the much stronger NT dollar exchange rate. Gross margin improved by nearly 7% percentage point to 26.5 compared to 19.2 the same period of last year. And gross margin, operating margin improved to 16.2% from 8.1% in first quarter of 2020. So EPS will show a pretty significant growth from 0.19 in Q1 2020 to 0.85 to this past quarter. On page 6, our cash is around 107 billion NT dollars, and total equity is about close to 250 billion NT dollars. Like I mentioned earlier, the Q1 revenue growth contributing both from ASP growth as well as wafer shipment growth. And on page 7, you can see there's more than 3% uptick in our blended ASP for first quarter of 2021. In terms of revenue breakdown on page 8, Asia continued to grow, and right now it represents about 63% of our total revenue. And Europe and Japan also show mild growth in first quarter of 21. For page 9, IDM still unchanged, around 14%. And on page 10, we see some more balanced distribution among 3 major segments. So consumer now represent about 27%, and communication is about 46%. And for page 11, 28/22 nanometer technology represent about 20% of our total pie in Q1 2021, and 40 nanometer represent another 20% for Q1 2021. On page 12, our capacity breakdown for quarter 2, we will see some 4% quarter-over-quarter capacity growth, mainly coming from 12-inch capacity expansion at both 12A as well as 12X in Xiamen. And on page 13, we revised up our annual CapEx budget mainly due to a new project in Tainan, which we will go into details later. And for the new updated CapEx for 21 is now $2.3 billion. So the above is a summary of UMC results for Q1 2021. More details are available in the report, which has been posted on our website. I will now turn the call over to President of UMC, Mr. Jason Wang.
Thank you, Qidong. Good evening, everyone. Here I would like to update the first quarter operating result of UMC. Amid the semiconductor component shortage, we are working with our customers, suppliers, and partners to alleviate the capacity tightness across the supply chain. In Q1, robust wafer demand led to a full utilization in our manufacturing site, bringing overall wafer shipments to 2.37 million 8-inch equivalents. For the quarter, our gross profit grew 15.2% quarter-over-quarter to NT 12.49 billion, which partly reflected higher contribution from our 28 nanometer technology. During the first quarter, we continue to see an increase in 28 nanometer wafer shipments, driven by strong wafer demand associated with digital TV, set-top box, and connectivity chips designed into smartphones. As a result, 28 nanometer revenue grew 18% quarter-over-quarter, representing 20% of our wafer business. Furthermore, we have started to ship 22 nanometer products to fulfill consumer demand, leading to a recognition of 22 nanometer wafer revenue in first quarter 21. We foresee a significant pickup in 22 nanometer product tape-out that will increase our 22, 28 nanometer product pipeline, optimize overall product mix, and enhance UMC foundry share. Looking into the second quarter, market demand will continue to outpace supply, which will lift wafer shipments and blended ASP in US dollars. Recent market dynamics have provided us and our customers an opportunity to reinforce our CapEx strategy within the ROI boundary while trying to alleviate the long-term capacity constraint in the supply chain. Therefore, our board of directors have approved an investment plan which will expand the capacity at UMC Fab 12A Phase 6 in Taiwan Tainan Science Park through an innovative win-win partnership model with several leading global customers. The P6 expansion is scheduled for production in the second quarter of 2023, with total investment for the project earmarked at NT 100 billion. In addition to UMC's previously announced 2021 CapEx of US 1.5 billion, the bulk of which is allocated for the equipment for the company's Fab 12A P5 site adjacent to P6. Total UMC investment in the Tainan Science Park will reach approximately NT 150 billion over the next 3 years, P6 program is supported by a multi-year product alignment between UMC and the involved customers that includes a loading protection mechanism that will ensure the P6 capacity is maintained at a healthy loading level. We look forward to leveraging our number one worldwide foundry market position in multiple areas, such as 28 nanometer OLED driver IC production, so we may further strengthen UMC's semiconductor industry relevance and capture new market opportunities down the road. Now, let's move on to the second quarter 2021 guidance. Our wafer shipments will increase by 2%. ASP in US dollar will increase by 3 to 4%. However, the surging NT dollar headwind may potentially offset benefits on Q2 shipments increase and ASP growth. Gross profit margin will challenge to 30%. Capacity utilization rate will be at 100%. Our 2021 cash-based CapEx will be budgeted at US $2.3 billion, as Qidong mentioned earlier. That concludes my comments. Thank you all for your attention. Now we are ready for questions.
Yes, thank you, President Wang. And ladies and gentlemen, we will now begin our question and answer session. If you have a question for any of today's speakers, please press 01 on your telephone keypad and you will enter the queue. After you are announced, please ask your question. If you find that your question has been answered before it is your turn to speak, please press 02 to cancel the question. Thank you. And now please press 01 to ask the question. Thank you. Our first question is coming from Randy Abrams, Credit Suisse. Go ahead, please, Randy.
Okay, yes, thank you. Congratulations on the result and margin improvement. First question, I wanted to ask on the capacity expansion. Could you discuss the amount of capacity for the Fab 12A Phase 5 with the CapEx raise, and also how much capacity is planned for Phase 6 with the 100 billion NT plan? And if there's a framework for total CapEx, if you also expect any spending to continue in China or other facilities, if there's a view the current year's spend may continue around this level for the next couple of years.
So, Randy, for P6 alone, the total capex is around 100 billion NT, and it's likely the spending is likely to spread out through over the next 3 years. So, starting from later part of this year, bulk of that in 2022, and also nearly 1/3 in the 2023. So that will be the key part of capex over the next 3 years. And for the original budget of 1.5 billion, the bulk of that will go to the 10,000 wafer 28 nanometer capacity per month at P5, and that's already ongoing. And we are seeing the contribution earlier, maybe as early as next year. For Xiamen, we are also already reaching to the target, closing to the target level of 25,000 wafer per month. And as you recall, it was about 18,000 wafer by about the same time last year, but through the expansion now it's close to the full capacity right now. So maybe Jason, you want to add a few more?
I think the other data point is for the Tainan facility. After the P5 will be about 90,000 wafer capacity total for the Tainan site, the 12A. And by adding the P6, will be on top of the 90K. So we're approaching about 120,000.
Also 10K from P5.
Right.
Okay. So and to clarify, it's 90K to 10K P5, P6 is 20K, so that brings it to 120. Okay. And the second question, it gets back to the mechanism and this new expansion schedule. If you could talk on how the pricing and margins as you expand and grow the business with the new capacity, how would that impact relative to your current margins where they're getting to 30%? And if you could give an updated view, the depreciation, where it was originally on that kind of nice downtrend the next 2 years, but now you'll get more growth. But how does the depreciation profile change?
Well, I mean, without going into specific about the actual pricing, I can update. First is our discipline, our ROI-driven strategy did not change. So this program will not affect that strategy. Starting in 2023, this program will support our top-line growth, like you said, with multiple years of margin accretion. So this financially, we believe this is justifiable. As we stated earlier in the P6 press release, this P6 expansion will run at second quarter 2023. And in the meantime, the near-term downward depreciation trend remains unchanged. Even post-2023, UMC total depreciation at a percentage of revenue will be well controlled and managed. Mainly because after a few years, our light CapEx depreciation curve rolled off. Together with our gross margin improvement, this effort will have strengthened our financial position to capture this market opportunity. So I think our customers also recognize part of the market structural changes. So they perceive this arrangement is meaningful to them, but also beneficial to them. Yeah.
Okay. And one last question. The blended pricing start of the year was, I think, kind of a minimum plus 5%. If there's an updated view with ASP up 3 to 4 in the second quarter, but also there's a lot of talk in the market. There's further rounds with the capacity tightness. If you could give a view on pricing, and is there an initial view how 2022, if you're already contracting out and may see some movement up on pricing into next year?
Well, we will continue aligning with our customer. From the recent market dynamics, our forecast for the full year ASP growth will be in a high single digit year over year now, and it could approach 10%. And this 10% of our pricing also includes our product mix improvement, and therefore the current ASP list mainly reflects the value of overall market position, but it is more aligning to the market price and market position. So at this point, we see the entire 2021 will be approaching about 10% year-over-year growth on ASP.
Okay. And is there any talk on 2022 yet, or is that normally as scheduled, like in second half? But are you starting early given the constraints?
They are ongoing discussion, as I said earlier. Hopefully we can wrap up not only just the pricing, also capacity support alignment, early, before mid of the year, and so that is still ongoing at this point.
Okay, great. No, thanks a lot.
Sure.
And the next question is coming from Bruce Lu, Goldman Sachs. Go ahead, please.
Hi, thank you for taking my questions. Very great result. Can you give us a little bit more color about your innovative business model for the new fab? Because, I don't really see any details. But the problem from the investor is that when TSMC, who dominate in 28 nanometers global capacity, the chairman is talking about double booking and oversupply in 28, and we are building additional 28 nanometers capacity. How can we ensure that the capacity, the newly added capacity, is fully loaded? What kind of mechanism we can have, or because we have seen so many long-term contracts in many industries, and a lot of customers just don't honor the contract at the end of the day. So how can we ensure that we can get our desired returns?
That's actually a very good question, and it can be a short answer and long answer. Let me see if I can maybe start off, giving a bit of the background of this decision. The recent market dynamics lead to a supply-demand imbalance, as everyone knows, particularly in the mature nodes. Some of our peers in the market also mentioned about that too. In the past few years, we have seen most of capacity expansion focused on advanced technology. However, the company did not significantly address the mature 12-inch and 8-inch capacity over a period of time due to a challenging market condition. Within those mature 12 and 8-inch nodes, there are many critical components that play the vital roles in the semi supply chain. Therefore, we believe this event has structurally changed our role and position as a foundry service provider. And I think our customers recognize that. And so at this time, this situation starts providing us and our customer an opportunity to work closely. And we have to solve the supply shortage together in this mature node. So the behavior of this, toward to this agreement with the customer is different than just we put in a CapEx for them. And we call this innovative win-win cooperation model because this arrangement is supported by a multi-years of product alignment. So this is a multiple years agreement between UMC and the customers. And under the alignment, there's also loading protection mechanism to ensure the capacity to maintain in a healthier loading level. So in other words, this P6 program is well protected with a commitment and obligation on both sides. Now, when you talk about this cyclical risk, this P6 only account about 10 to 15% of our operations. With or without the P6, the rest of the other capacity offering will be more vulnerable to the industry's cyclicality. So I think the P6 program itself is set up well protected. Our focus is more on the base of our capacity. And at the end of the day, our goal to protect our base capacity is we have to continue our relentless enhancement in the technology competitiveness and our manufacturing excellence. And with a predictable yield stability, our service, and the sizable capacity offering. So those are the fundamental solutions to cope with the industry's cyclicality. And so the bottom line is I think the P6 program itself is more well-structured, well-protected, but the market ups and downs, it will happen. But from our current academic methodology, based on our best effort, we think the demand and supply imbalance situation with those mature nodes will stay for some time. The conventional concern, inventory correction, or the market ups and downs probably won't happen within 1 to 2 years. But beyond that, we have to still go back to focus on our fundamentals. So that's sort of how we view about this.
So, but that creates actually a bigger problem. For example, like 28, right? Your current capacity is like 50 to 60,000 wafers a month. So the additional 20,000 is well protected in 2023 onwards, but the remaining 50 is not protected. So if the customer is having capacity in the both sides, they will fulfill the P6, but they can cut their orders from the the original previous 50,000 wafers per month capacity. Is that right?
Yeah, so what I'm saying is from a competitiveness standpoint, whether we have a P6 or P5, we have to deal with the same situation. And if in order to protect or compete in that space, our competitiveness advantage is not going to be based on this imbalance, or even people talk about geopolitical or trade issue or so on and so forth. Our core competence will result from our focus in our addressable market segment, and which we have been doing for the past few years. Another simple word to put it is we focus on a selective market area within our addressable market segment, and we deliver comprehensive technology within that segment, and then we start aligning with the customer and strengthen our portfolio, and as a result, we actually start seeing a market gain on that as well. So we have to continue executing that, and to protect the baseline. And so I think we march into the direction we feel comfortable, and we feel that we have been stay focused in a select area. We have been executed, and we become more relevant. So at this point, and we think we just have to continue executing that. And the market risk is continuous, and we don't have the, we don't have the confidence that the market will never happen, in this cyclical situation. But you have to prepare yourself to compete in that situation.
Yeah. I see. Okay, one clarification for the P6 investment. You mentioned that the ROE target or return-driven target is unchanged. But for me, it's like the current wafer price for the 28, cannot justify the return. How can this P6 return being secure, or how can we ensure that it will not be margin dilutive for this incremental revenue, or how can we ensure that the incremental ROE is not dilutive?
Because the current program has a predetermined pricing for the P6 program, and based on that, the program not only support the top line growth, they also support our multi-years margin accretion.
I see. So this P6 wafer price will be different compared to your existing 28 nanometer capacity.
It is different, yes.
Understand that. But can we disclose somehow the price premium?
No, we can't.
Fine. Thank you. I'll go back to the queue.
Sure. Thank you.
And the next question is coming from Gokul Hariharan, JP Morgan. Go ahead, please.
Thanks for taking my question. Firstly, for this new capacity arrangement, could we talk a little bit about what level of involvement do the customers have? Do you consider any potential co-investment from the customer, and any thinking on why you accept co-investment or why you don't accept any co-investment? Just wanted to understand that part. And when we talk about ROI boundary, could we put some numbers around it so that it's easier for us to communicate to investors also in terms of what is kind of like the ROI boundary that is kind of like a hard stop in terms of where UMC will not invest?
Well, first of all, in addition to what I just mentioned earlier, has a predetermined pricing arrangement for P6, and there's also a guarantee to their commitment by committing to the capacity deposit as well as the loading protection. Okay, so there's a structured mechanism to protect the P6 program, and I kind of highlighted earlier in the background of this current market situation, because the market dynamics. So this group of customer is willing and recognize the possible structural changes, so they participated this with us jointly. So I would say this is a joint program between us and some of the key customers, and so the financially based on that arrangement will not affecting UMC's the bottom lines, and also provides UMC's the top line growth. And we have spent a lot of time discussing this and sharing many of data, and we both agree this is the right thing to do to solving the shortage issues, and without affecting UMC's disciplined ROI-driven strategies. I can't elaborate more about the specific ROI numbers, but I can tell you that under our board of directors review and our team's review, and we see the bottom line with the margin accretion, and that meets our financial targets. So and again, I also mentioned earlier with the P6 program, the near-term downward depreciation trend remains unchanged, even post the 2023 after production start ramping. So, we feel this is well-structured a program for us.
Got it. Understood. Just one other question. Is there any change in terms of the shipment outlook? I think you did talk about blended ASP being up maybe about 10% this year compared to previous. I think we're expecting a little bit more, like mid-single digit. Shipment growth, the capacity growth outlook for this year, are we still roughly looking at 3 to 5% capacity growth this year, or is it a little bit better now?
Yeah, that capacity growth is the same for the year. Yeah.
Understood. Thank you very much. I'll go back to the queue.
All right, thank you.
And the next one is from Roland Shi, Citigroup. Go ahead, please.
Hi, good afternoon. First question to Jensen. Jensen, in your prepared remark, you said the first quarter gross profit growth was partly reflects higher contribution from 28 nanometer revenue. So question is, how about the 28 nanometer gross margin compared to the corporate average in first quarter? Are we seeing 28 nanometer gross margin above corporate average already?
We don't give out any breakdown by node. Okay, so the 28 becomes a meaningful node to us now, and on both sides, both on the top line and the margin contributions.
If I may, the 28 is actually compared to itself over the past few quarters. So the gross margin of current 28 nanometer is actually much better than the past few quarters.
Okay. Yeah. Then how about the overall 8-inch and 12-inch gross margin? I think previously you also said 12-inch gross margin was below corporate average. Then after this price adjustment, how about your 8-inch and the 12-inch gross margin look like?
Yeah, price adjustment is really a reflection of our market value. It comes from both absolute price increase as well as product mix increase. So it doesn't really change too much about the dynamic between 8-inch and 12-inch. And 8-inch, as you can understand, that it represents carry much less depreciation. So on an accounting point of view, the number always higher than that of 12-inch. But if we're talking about EBITDA margin, then that may not necessarily be the case. So overall, we were happy with the progression that 12-inch, especially 28 nanometer, has improved from a profit margin point of view.
Understood. Yeah. And you also talk about you starting to ship 22 nanometer product because of customers' demand. So for this 28 to 22 nanometer migration, how about the margin or profitability change? Is this 22 nanometer is carrying a much higher ASP and carry a better gross margin than 28 nanometer?
I mean, typically we provide the blended gross margin number without breaking down by detail. So it's hard to pinpoint on each node. But I also like to add the gross margin is a result not just the product mix. The 12-inch wafer shipment contribution, 8-inch pricing, justification, as well as the continuous cost reduction effort and our productivity improvement. So this is more of a blended result on everything, and it's not just associated with one particular node or fab. So we're happy that we start challenging the 30% in the upcoming quarter. I think given what we have done, and we have confidence we'll continue to improve on that too. Yeah.
Okay, thanks. Last question about me. I think a couple months ago, you were comfortable of the total wafer supply. And has you changed your view, recently due to this, increasing wafer demand? So, are you able to secure enough raw wafer from your suppliers?
Yeah, we had that issue a while back, and we have been diligently working on that and closely aligned with our supplier and managing the supply assurance. So we haven't seen any problem right now. No.
Okay, so you have secure of this wafer source. How about for the wafer price change? Do you see a meaningful wafer price change recently?
We see this pricing dynamics across the supply chain, and I can't tell you what's going to happen tomorrow, but at the current stage, based on the alignment with our supplier, we okay with the current pricing structure. Yeah.
So do you see the pricing going up or?
I don't have that visibility going up at this point, but I don't know will that change tomorrow or not. Yeah.
Okay, understood. Okay, thank you. Yeah.
Sure.
And the next one is from Zihong China Renaissance. Go ahead, please.
Hi, good afternoon, gentlemen. I have two questions. The first one regarding the 40 nano strategy. Because some of the 28 nano products have plans to go into the 40 nano. So I'm not sure if UMC would start assessing the 40 nano expansion possibility.
Yes. The P6 program, the arrangement with option to migrate into 14, and the possible time frame will be sometime in 2024. But there's no plan before that.
I see. Got you. And regarding the collaborative expansion with the customer, the company will have some sort of a loading protection mechanism. So I just wonder how long would that protection clause last in general?
It lasts entire the program. Yeah.
Oh, okay. All right. Okay. All right. Thank you very much. Yeah. Great result.
And the next question comes from Charlie Chan, Morgan Stanley. Go ahead, please.
Thanks. Good afternoon, gentlemen, and congratulations for a very strong results. So my first question is also regarding the P6 project. So I saw some news flow, so just want to clarify. Is there any equipment consignment from customers? Can you clarify the point?
No. The answer is no. There's no two consignment from customer. Customer will guarantee their commitment by providing the capacity deposit.
Okay, so it's almost all from your balance sheet.
Yes, it is.
Okay. So with that, do you need to increase the kind of debt ratio or do some fundraising to sponsor the future capex?
Yeah, our current cash on hand is about a little bit more than $100 billion as well, and we just announced this exchangeable bond project, which will likely to raise another $600 million for us by disposing our non-core assets. So I think from a financial standpoint of view, we even can maintain our current high dividend payout ratio in light of this new P6 project. So there's pretty much no impact on our financial structure.
Okay, thanks, Chi-Tung. So back to the P6 business, right? You mentioned that there are several types of demand, including OLED, driver IC, wireless connectivity, set-top box, TV, etc. So for that kind of P6 or kind of a long-term demand, which customer or which product type is a major driver for this P6? Or the demand comes from, even if from the current projects?
Well, I mean, first of all of them are global leading semi companies, and I can't really name names. And the customer's products and our technology roadmap has been well aligned, and it's also our existing customers. At the same time, this customer, along with their demand outlook in their addressable market segment, in our view, will outpace the semiconductor industry projection. So it's in a high growth area. And so, we believe this is more well-positioned program to secure the P6, capacity as well as fuel their future growth. Yeah.
Okay. So it seems like the future demand came across board from the existing customers, not just a single or a few products. Is that right interpretation?
Yes, it's a multiple customer with multiple products. Yes.
Okay, thanks. And then a minor question is about the trend of the 8-inch, some 8-inch project migrate to 12-inch. I'm not sure if that is happening within your fab, but you see that trend of those, for example, large panel driver IC, power IC, sensors. Those products you used to use the 8-inch as a major foundry source. But going forward, do you think that those may migrate to like a 12-inch? And maybe a year or 2 years later, do you think 12-inch is more efficient for those kind of specialty semi products?
Well, I mean, every application, the most of it is, migrating from 8-inch to 12-inch due to, like you said, the performance reason or cost advantage. So there's a continued product pipeline, within different applications, and including what you mentioned, and we continue to align with the customer on that. We don't observe any 8-inch demand overflow to 12-inch because the overflow because of 8-inch is high, and so we haven't really seen that. But we continue seeing that on a by application basis, and because the product performance reason, because the cost reason, and they continue migrating to a 12-inch. And even within the 12-inch, they continue migrating into different nodes.
Okay. Thanks very much. So I think does that mean that 8-inch foundry supply shouldn't see a structural shortage? I mean, because there's a kind of alternative, right, to use a 12-inch. Is that right understanding?
I think the advanced 8-inch has a structural shortage issue. The demand continue, being very strong. However, due to the market challenges on building a greenfield 8-inch facility is very difficult. So, we see that come online as, not as fast as the demand grows. So we, at least for the foreseeable couple of years, I think the 8-inch will remain challenges, and we're still under structural, constraints here.
Okay. Yeah, and last question maybe back to Chi-Tung. So can you help us to understand your gross margin trend into next few years? I know you don't give a next year margin guidance, right? But just based on management's comments just now, you seems to suggest that the P6 wouldn't dilute your gross margin, even though the capacity is from your own balance sheet, right? So can you help me to understand, what will give you that confidence into next year's gross margin will continue to go up? Is that because of the further price hike, or the old equipment depreciation going down? Because I feel like now you are running at 100% utilization already, right? So the margin benefits from the higher utilization doesn't seem to be the answer to that. Can you help us to understand? Thank you.
Yeah, first of all, we didn't say the gross margin will go up sequentially in 2022. We didn't say that. Okay, we say the gross margin is a collective effort of cost reduction, ASP reflecting the market, and also product mix adjustment. So we are doing all of that, and hopefully we can continue to improve our gross margin. But we will keep our gross margin guidance quarter by quarter. And as for the P6, it's going to represent about 10 to 15% of overall operation, and with a prefix price, and with the ROI exempt target. So if we plug into our current base, that's the basic assumption leads us to mention that we don't expect this P6 project will dilute our gross margin. And because it's going to be profitable from the very beginning, it's actually going to be adding driving force to our overall ROE performance.
Yeah, so I remember last quarter you gave us some depreciation trend, right?
Depreciation trend wise for 2021 and as well as 2022, we are still looking for somewhat less than 5% annual decline in the full year depreciation expenses. And beyond 2023, when the P6 numbers start to kick in the mid of 2023, the number still will be well under control, and the trend will not be reversed.
Oh, okay. Sorry, I missed that. So one last one is auto semi production. I mean, how much is the revenue contribution? I'm not sure why you start to disclose that auto semi exposure, and I guess the global investors really very keen to get your sense about when does the auto semi output will go up from your side, and also when do you think the shortage will ease?
Well, I mean, the shortage right now is across the board, and we just have to work with our customer closely, and along with the productivity improvement as well as the new capacity expansion. The auto segment itself, we haven't really break it down in our pipe. Is categorized under the others. So right now the others account about 11%. So for our automotive market, is within the numbers.
Okay, understood. Thanks very much for your time. Thank you.
Sure.
And the next one is from Sunny Lin, UBS. Go ahead, please.
Hi, thank you for taking my questions, and congratulations for your great results. My first question is also on your P6 expansion. I think you just put out a press release saying that the fab show has been completed, but the mass production will only start from second quarter of 2023. So wonder if that's because of the equipment supply constraint that we are now seeing in the industry, or is there any possibility that the mass production could actually start earlier than expected?
Well, I mean, we are working with our suppliers, and at this point we'll see there's a lead time for the overall equipment. So we project the P6 will ready for production on second quarter 2023. That's what we're targeting, but we're still confirming with our suppliers to ensure that will happen. So that's the current plan.
Got it. Maybe a follow-up to your 28 expansion. Since most of your capacity is built several years ago, and therefore depreciation start to come down, if we compare the production cost for the new capacity versus your current capacity, wonder if you could share with us any color in terms of the cost increase?
Well, first of all, I don't think there's a cost increase. So once you reach to certain economic scale, the overall cost is actually coming down. So
right.
We don't think building a factory now compared to what we're building the capacity 6 years ago is higher, and it's actually, in fact, it's actually lower. Okay, and we in terms of the capex budget that we presented, we don't generalize this figure, given that our P6 program has the flexibility that converting into a 22 nanometer as well as a 14. That was the earlier question, if we consider a 14, and the answer is yes. So the entire program has certain flexibility converting that into the 14 nanometers. And so we want to make sure this, when we plan this, we have that flexibility. Okay. And so, we can't really generalize this figure to what 6 years ago. But in general, the current 28 cost is lower than what we built 6 years ago.
Got it. Thank you. That's very helpful. My second question is on the overall supply-demand imbalance, and that's now, I think, driving several foundries to accelerate the CapEx for their trailing edge. So just want to get your sense if in the medium term this could lead to overexpansion or more volatility for the whole industry. Thank you.
Well, I mean, I kind of touched this earlier as well, but once the newly capacity become available, we anticipate the supply imbalance issue will be addressed. Okay, but nonetheless, the structural shortage in the mature node, we think will remain unchanged until 2023. Okay, given the lead time consideration. Okay, based on our research and study, we think there's a good chance they won't have any excess capacity. Okay, it's probably not likely to happen within the next 1 to 2 years. Okay, in addition to that, consider beside the lead time, capacity build-out lead time, and also the uncertainty of the geopolitical tensions. We have pretty good confidence this tightness will probably continue for at least 1 to 2 years. Yeah.
Got it. Thank you very much.
The next question comes from Stephen Chen, Elite Capital. Go ahead, please.
Hi, thank you for taking my question. And I have 2 questions here. First is, I'm just wondering, because we see for some leading edge technology, we don't really see clients have the same product using dual sourcing. I'm just wondering if you look at the 28 nanometer now, do you think clients usually use only one foundry for the same product, or for the same product, a client could still use dual sourcing? This is my first question.
This is several different perspective on this. Okay, one is from the customer's perspective. If a customer believes they need a multiple sourcing strategy to ensure their supply chain, and they have the design resources, I think the customer is capable to do so to enable multiple. If they believe single source and enable their the supply assurance, and without being double the design effort, they probably don't need to. So one perspective is from the customer's perspective, from the supply chain, and from the design and the product specific, and that's a different consideration. They very customized, so they very hard to have a multiple source. So because the characteristic of the product itself. So when you're talking about the advanced node, because we don't serving on the very leading edge node, so I can't really give you a comment about UMC specifically. But I can tell you as a general sense, design into an advanced node is very costly. So if you want to enable multiple source, it will be a significant investment. So I think that is one of the important factors here.
Yeah, understood. So actually the question was asking if the comment you just made also apply to 28 nanometer?
If you look at the 28 capacity, I think most of the product they be able to enable multiple source. I think as long as the customer wants to do it, there will be some differentiation and on the technology side. For UMC, we have a few of leading market position on some of the technology solutions, and for those, I think we're still ahead, in the market. So we probably will enjoy better customer stickiness on that.
Understood. Thank you. Another question is that, also just very quickly. So we understood that for the mature node, like 200 millimeter, 300 millimeter mature node, they are all in supply tightness or shortage now. But if we really need to do a comparison between the two, do you think it is tighter or the bigger shortage in 200 millimeter or in 300 millimeter?
Well, this is an interesting question. Okay, from our view, what we see, they severely unconstrained on both the 200 millimeter as well as the 300 millimeter mature nodes. But there's a possibility also the customer is a double booking on that to ensure they be able to secure supply. So how to judging the overbooking is very difficult. But I can tell you at this point, I think on the industry wise, we are under severe shortage across the board on the mature node.
Yeah, thank you. So just a very quick follow-up on your last comment. So you mentioned about probably due to possible overbooking. But previously, you also mentioned you see the tightness will continue probably for another 1 to 2 years. So can we assume when you make the comment regarding supply tightness sustainability, you already try to exclude you already try to consider the possible overbooking?
Oh, absolutely. I mean, this is a planning 101. So we have to consider that, and we actually based on our research and study, we actually going back all the way to the end market, entire pipeline in terms of supply chain to analysis that. So I think that there's a few mega trends in this space driving the demands. From 5G smartphones, the automotive, EV adoptions, as well as the learn from home, work from home space, and so those demands are real. Okay, so and if you look at the past years, there's this lack of a capex in the mature node space. So structurally they just not enough, and so that's why we believe even with the P6 or even with any announced capacity today in the foundry space, we still believe this the structural shortage will probably remain.
Yeah, thank you. Very clear and very good result. Thank you.
Thank you.
Ladies and gentlemen, we're running out of time, so we're taking the last question. And the last one is from Bruce Lu, Goldman Sachs. Go ahead, please.
Okay, thank you for taking my question again. I have a question about the ASP. For the first quarter, ASP as a blended base improved by 1.3% only, and which is pretty much driven by more 28 nanometers product mix improvement. So where is the price hike the market is talking about? I mean, also for the second quarter, the capacity is growing by 4%, but shipment is growing by 3%. But I'm assuming that the new capacity addition is mainly for 28 nanometer capacity, which is supposed to have a much bigger, much higher ASP. The ASP guidance for second quarter is also like 3-4% only, which is again pretty much driven by 28. So as a like-to-like base ASP, do we see any improvement?
Well, there's a lot of correct. The first quarter ASP growth was actually more than 3%, not 1 point something. So as I mentioned, more about some of that come from price increase, so less than 3.2%, and some of that come from product mix improvement. So overall, quarter one ASP growth was more than 3%.
I see. What is the Forex assumption in first quarter? Because it's using
Forex was 28.3. So there was a nearly 2% negative impact on forex.
I see. Understand that. So for the second quarter, what is the ASP? What is the assumption for the ASP? Expansion driven by the product mix improvement.
Still similar, I would say both are key factors which contribute nearly 50-50 each. So we normally don't give the detailed numbers, but you should expect to see a similar driving force for this 4% growth for quarter 2 in ASP.
I see. Okay. Last question. I just did a very quick math for the P6 28 nanometers wafer price. It seems to me that you want to have a similar return. The wafer price for that 28 has to be like 50% plus higher than the current market price. That seems too good to be true from my simple math. So is there anything I'm missing, or is that math sounds correct?
I can't really comment on percentage, but there is a predetermined pricing arrangement with the customers. It's actually a very diversified customer portfolio. The bottom line is the mechanism works. The methodology, the math works. Okay.
The math. So my math works.
So I can't comment about the percentage of that.
Yeah, it is only one aspect of the total ROI calculation. We also factor in the benefit of the economy of scale and also the cost reduction effort and et cetera, all the factors our president just mentioned. So again, it's a collective effort.
I see. Understand. Thank you.
Thank you.
Thank you. And ladies and gentlemen, we thank you for all your questions. That concludes today's Q&A session. I'll turn it over to UMC Head of IR for closing remarks. Thank you.
Yes, thank you for attending this conference today. We appreciate your questions. As always, if you have any additional follow-up questions, please feel free to contact UMC at ir@umc.com. Have a good day.
Thank you. And ladies and gentlemen, that concludes our conference for first quarter 2021. Thank you for your participation in UMC's conference. There will be a webcast replay within an hour. Please visit www.umc.com under the Investors Events section. You may now disconnect. Goodbye.